When you register a new company, the most important decision that you'll make is who will be the shareholders and how many shares each shareholder will get. When starting a business, the shareholders are usually the people who finance the business and risk their own money in order to make future profits. The shareholders therefore own the business while the directors manage the business. By the way, most companies that are registered in South Africa are private companies, and in most private companies, the directors and the shareholders are the same people. But this does not have to be the case. Just to be clear, in this video, I'll be dealing with Pty Limiteds, directors and shareholders, and not closed corporations which have members and percentage memberships. You need to decide how many shares you would like to create. These shares are issued to the shareholders, so the total number of shares that you decide to create is called the authorized share capital. And these shares legally belong to the company. They are dormant and have no rights associated with them until they are issued to the shareholders. The rights such as voting rights, preferential dividend payouts are only binding once the shares are issued to the shareholders. You can choose any number of shares to make up the authorized share capital. We use 1,200 shares as it is our default amount. This is because you can't own a fraction of a share. This only becomes a problem if your authorized capital is 1,000 and you have 3 equal shareholders all wanting a third ownership. So 1,000 divided by 3 equals 33.33. The problem is the 0.33 of a share, which is not allowed. So the one share will either have to be jointly held or remain unallocated with the company. Therefore, 1,200 is a more practical number as it is divisible by most numbers. For example, if you are 3 equal shareholders and each shareholder will get 400 shares, 1,200 divided by 3 equals 400. There's no fractions to complicate the transaction. However, you do not have to issue all the authorized share capital to the shareholders. Some of the shares can remain unallocated within the company. The amount of authorized share capital is stated in the Memorandum of Incorporation, or MOI, which you will receive when you register your company. It describes the number and types of shares and the rights and limitations associated with each class of share. We use the standard MOI as drafted by CIPC, as it is cheaper and it's already compliant with the Companies Act. It also only has a single class of ordinary shares, which simplifies matters tremendously. There's no need to concern yourself too much with this document when you register your company, as it can always be amended at a future date. Now, the next concept to get to grips with is the number of authorized share capital has nothing to do with the value of your company. Many of our clients get confused with this, as they feel that the more shares that they create when establishing their company, the more valuable their company will be. This is definitely not the case, because the value of a company is completely independent to the number of shares. The value of a company is based on many factors, but in the end it boils down to a willing buyer and a willing seller, what they agree upon. It has nothing to do with the number of shares. So let me give you an example. Let's assume a company is valued at R1,000,000. Now, to determine the value of each share, you must divide the value of the company by the number of shares. For example, let's say we have 100 issued shares in total. The value of each of these shares is therefore calculated by dividing the value of the company by the number of issued shares. So it's R1,000,000 divided by 100 equals 10,000 Rand a share. If the same company now has 1,000 issued shares, then the value of each share will be 1,000,000 divided by 1,000 equals 1,000. So the value of the company does not change. It's the value of the shares, which we call non-par value shares. A final point on authorized share capital is that you should not concern yourself too much on how many shares you should create. This is because the authorized share capital is not cast in stone and can be increased at a future date should the need arise. Now that you have a better understanding of authorized share capital, the next major concept is the implications of transferring shares to the new shareholders. Now, there's a lot of share terminology used in the business world, such as issuing shares, transferring shares, allotting shares. But in the case of private companies, they all follow the same procedures. Let's compare 2 private companies. Both are valued at R1,000,000 and both have 1,200 authorized share capital. And both only have one shareholder. Company A, all the shares, 1,200, are issued to the shareholder, meaning that he holds 100% of the company, while company B, only half the authorized share capital, or 600 shares, are transferred to the shareholder. But because he owns all the issued shares, he also owns 100% of the company. The remaining 600 shares there remain unallocated and still belong to the company but have no rights. Let's assume both shareholders want to sell 50% of their company to a new investor for R500,000. Company A, the shareholder transfers 50% or 600 shares from him to the new investor, and he receives the R500,000 in his personal name. This is because the shares are transferred from his personal name to the investor. The company therefore does not receive any funds. However, with Company B, he has two choices. The original shareholder could sell 50% of his 600 shares and also receive the money in his personal name, just like Company A, but that will only be 300 shares. Or he can allot the remaining unallocated 600 shares to the new investor. The difference here is that the investor now pays the company and not the shareholder. Now this has very different tax implications, and from an accounting perspective, the seller effectively only gets half the money owed to him. To eliminate these complexities, we at Swiftridge have chosen to issue all the authorized share capital to the new shareholders when registering a new company. This has been a reasonably technical video, so let me summarize some of the key points. When registering a private company, you can create any number of shares as your authorized share capital. Number two, we recommend 1,200 shares as your authorized share capital, as it is divisible by most numbers. Number three, the value of the company is unrelated to the shares. Number four, it simplifies matters if all the shares are issued to the shareholders on registration. The fifth point is that the MOI can be amended at any time. And finally, the authorized share capital can also be increased at any time. I hope you find this video helpful. And so if you have any questions, please leave a comment below and I'll try my best to answer it. So until next time, remember, we are here to help.